is your home an asset or a liability? It's both. I think of real estate ownership as business ownership. It has liabilities, but it is also an asset. It can be both of those things, right? I have a liability. I have bills to pay. I have an HOA to pay. I have whatever, taxes, insurance. Those are liabilities that I must pay. But also, my house has marketable value that I could sell.
My mom's getting old. I want her to come live with us. I'm going to build an ADU on my garage for my mom to live in. I can't do that if I rent my house. By the way, doing that is going to make my house worth more money. Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with Brady Mullen. Brady has 19 years of experience in accounting and financial planning industries. He's a seasoned professional recognized for his practical insights and has consistently delivered results that empower individuals to make informed decisions. So, Brady, as I mentioned, I like to let you tell your story and your background in much more detail than I can ever get off of reading the bios. But first, thank you for being on the show today. Thanks for taking the time. Thanks for coming to chat with us. I'm definitely looking forward to it.
Thanks for having me.
Absolutely. Well, tell us about yourself. Tell us your background, kind of what got you to where you are today, and then we'll dive in from there.
All right. So I got into the financial planning space in my 20s. It seemed like, so my background, my schooling's in accounting, but I quickly realized I didn't want to do that. It's just a lot of record keeping and it wasn't really my thing. Not that all accountants do that, but I didn't want to do that. So I got into the financial planning space, built a practice, and 19 years later I sold it. And there was a lot of reasons why I did it. Some of them were personal but there was a big one, which was I remember, you have those moments in your life where you remember where you were when it happened. You didn't realize the significance of it at the time, but your memories get anchored to it somehow. And I remember thinking to myself, I wonder what my rate of return on real estate investments have been, like on my money. I know what you can look at historical appreciation, and you can look at cash flow historically, but that isn't your rate of return on the amount of money that you invested, because leverage throws all that stuff off, and expenses, and when they happen throws all that stuff off. And I remember thinking, I don't really know. I mean, it's been good to me, but I don't really know what my returns have been, and I should know that because I've been doing financial stuff and accounting for a long time, and I started scouring the internet for good calculators. And I never really found one that I liked very much. And the one thing that I noticed it was missing often, to be frank, was that it didn't account for the time value of money. So getting $1,000 of cash flow last year is worth more than getting $1,000 of cash flow this year. There's a time value of money because it's always got opportunity cost, and time and money are always related that way. So I started building out models for real estate related financial decisions. And it became clear to me, and this is while I was still a financial advisor, it became clear to me that the real estate related choices that we all make, and I'm talking about your residence and investing. So real estate investing is great, but also your real estate related choices about your own shelter have a huge financial impact on us as individuals, as family members, as members of the community. And I had exactly zero official training and continuing education for that as a financial advisor. And it's the biggest financial lever people pull. So that's what got me going down the path of trying to integrate the financial impact of the real estate related decisions that we make and integrating that with personal finance. Yeah.
I mean, that's fascinating. I completely agree that, it is the largest financial investment that most people ever make is in their own home. I completely agree. Most people are completely unprepared to understand their finances and have financial literacy. I am surprised to hear that you, as someone who is in the financial planning industry, also didn't have that, preparation going into it. You would almost think, or I guess I would like to think that if I go to a financial planner, that it's going to almost essentially start there in a sense, like this is, the house I have, and this is, what are my current assets, or what do I want my assets to be, that sort of thing. So I am surprised to hear that even in that industry, it wasn't, I guess, kind of front of mind, if you will.
Yeah, it's not. And in fact, I mean, we'll list it on the balance sheet. So when I was doing annual reviews of my clients, I would list their home and their equity and their debt on the home if they had a mortgage. Yeah. That would be listed on the balance sheet. But like we would count it, but we wouldn't integrate it into the financial plan, and we wouldn't give a lot of advice about it. So like a really common question that I hear from people, especially younger people, they're like, well, I'm just going to rent because it's cheaper on a monthly basis and I'm going to invest the difference. Now that implies a lot of math when you say that. That's
Hmm.
frankly pretty hard to calculate if you don't know what you're doing. And even if you
Right.
know what you're doing, it takes a lot of effort because there's a lot of moving parts to that. And if you, one of the things that I say a lot, so my brother's an accountant, that he did go down that path. He's a CPA, and we wrote two books about this, one about home ownership and one about reverse mortgages, which I think are probably the most overlooked financial tool on the planet. They're actually quite elegant and beautiful, but that's another story. But that question's a really good question, and people are used to making intuitive decisions about finances, but finances are very often not intuitive. So if you rent a place and invest the difference, is that better? Is that a better use of your money than buying a house? That's not an easy question to answer,
Right.
and it
Right.
sounds
Well,
reasonable.
yes, and I think that these are the things that like people can find the data to argue in either direction. But one of the big questions is always like, is your primary residence, should you consider that an investment? And I'm sure you get that question then, if this is your kind of area of expertise. My take on it has always been that 100% my primary residence is an investment, but it's because I treat it that way. I buy a house that needs to be fixed up. I treat it. I've had roommates. Like I've done all the things that people talk about in the real estate world.
Mm-hmm.
But even still, like your point to your point about what's the actual return on that? I don't know. I don't calculate it. I know I have. I know I would have paid more to to buy someone else's renovation, but I don't I don't know how to calculate that over time. But I do view it as an investment when I buy a home, even if it's the home I live in.
Yeah. Do you want to get geeky about it?
Yeah, yes, I want
Yeah.
I want to
So,
hear exactly your take on that.
actually, this way that I'm about to talk about it, I actually learned it from Grant Cardone, but in the opposite way. I think he's very wrong about personal residence stuff. He does some
Yeah.
things right. He's clearly wealthy and successful, but he said something once, and I don't even know if he still feels this way. I just heard him say it, and I thought, well, that's a dumb thing to say. He said, you should rent and invest your money with me or whatever he's
Right.
doing, and one of the reasons he said to do that is because you don't want to be your own landlord. Like that would stink. And I'm like, wait a second. That's exactly who you want your landlord to be. Like you have exactly perfectly aligned interests if your landlord is you. And if
Yeah.
you think about it, that's exactly what happens when you buy a home. A lot of people don't think about cap rate in the house they live in, but it's very real. So if I live in a neighborhood where the cap rate is 4%, I am benefiting from whatever that cap rate is. And for those listeners who don't know exactly what that is, I'm sure you do, but it's your net operating income as a percentage of the value of the house, the annual
Mhm.
net operating income. So it's an income metric. And so people often don't think about a cap rate on the home they live in, but it is there and it's present and it's real. But it shows up to you in a little bit of a subtle way, because what it is it's money you don't have to pay for shelter.
Right.
Right. So whatever the cap rate is money that I would have to pay if I was renting it that I don't have to pay because I own it. So that does show up in my cash flow personally. It just shows up by not going anywhere. Right. So it's not a check that I receive. It's just a check that I don't have to pay. An after
Yeah.
tax check I don't have to pay, by the way. And so people often don't think about that. They'll think, well, real estate appreciates at 3 or 4%. And it's like, okay, true. And it could be more or less than that. And we don't know what it will be in the future. But let's say it appreciates at, say, 4%. Well, if you live in an area that's got a 4 or a 5% cap rate, you're getting 8 or 9% without any leverage before you introduce leverage. You introduce leverage where I'm only putting, 10, 5, 3% down, 20% down, depending on what kind of, leveraging or loan you're using. That leverages everything else to an incredible degree. And so the return is actually a lot better than people think, but they don't account for all of that. Another thing that I hear a lot of people say that will promote renting and investing the difference is they'll say something like, yeah, but if something breaks, you don't have to take care of that and you don't have to pay taxes. And it's like, you completely don't understand business. There is no way, like a rental home is a business. And there's no way your landlord is selling you shelter for less than it costs him or her to provide that shelter. Businesses don't work that way. I mean, you might have a sweetheart deal with a family member or some you might be paying rent for $800 in a market that's $3,000 because you have some relationship with a landlord. That skews things, of course. But under normal conditions, you cannot buy shelter, or you can't rent shelter for less than it costs to own it long term. That's why real estate investors make money, is because they charge more than it costs them to provide it. And we can go down the list and account for all of those things. But if you just remember that high level, it's impossible for that to be sustainable.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Yeah. Yes, a bunch of really great points there that I want. I'm trying to, in my mind, where to go first. As you were speaking, one thing that kind of back to the question of is your personal residence an investment or not? The way you just described that made me think about this differently. The answer is yes. It's an investment. It's either a good investment or a bad investment, right? You treat it. You talked about the expenses and things. If you are trying to buy the biggest, most expensive house you can have and all that, it is potentially a bad investment, but it's still an investment. And so I think now all of the calculations you talked about, your mortgage, however much cash you put into it, all of these things are impactful in that calculation. But I think my point is you can improve your return by thinking of it as an investment, or just ignoring the fact that it is an investment and you may have not the same return over time. The other thing that, this piece about Grant Cardone saying you should rent and invest the rest of your money, that again implies that you'll rent for less than you would pay in mortgage in your home, and then you would actually go and invest that money. And so I think that the vast majority of people don't do that. If you're Grant Cardone and you're a billionaire and you rent and you still have billions left over to invest, that's impactful. If you're someone who is choosing between renting for $2,500 a month or buying for $3,000 a month, it's not really going to change your life, I think, in with that thinking. And I guess maybe I'd love to hear what you think about that. But there's reasons why someone like Grant Cardone could say something like that. He also wants investors. So, it benefits him to say you should invest with me. And so it's kind of, I just think that him saying that takes away kind of that personal, whatever your personal financial situation is. I still think investing is a good idea, but your home might be the best first investment that you can make.
I don't think I could agree with that more. So I think about it in a couple ways. A lot of people, we by nature, we humans like to categorize things and simplify things to make them, digestible and understandable. And people will often say, you said investment, but the one I hear more often, and maybe it's just the circles that we're running in, is they'll say, is your home an asset or a liability? And it's that's not a fair category. It's both. I think of real estate ownership as business ownership, right? It has liabilities, but it is also an asset. It can be both of those things, right? Yeah. I have a liability. I have bills to pay. I have an HOA to pay. I have whatever, taxes, insurance. Those are liabilities that I must pay. But also my house has marketable value that I could sell. So it doesn't have to be one or the other. In fact, it's both. So that's a common confusion. And when another really easy thing for people to overlook is the time value of all of this. So you might look at the cost of renting today, and you use the example of $2,500 versus $3,000 to live in a home. And then you add on top of that, any repairs and maintenance that might need to be done, and when you said the mortgage, I assume you're including the escrow. So taxes and insurance are a part of that. So it is more expensive from a cash flow perspective to own a house, unless you're putting, 50% down or 30, even 30 or 25% down can actually make your mortgage cheaper than what rent could be. But most people don't put 30% down or 20% down on their first home. And so they'll look at the cost of home ownership and they'll only look at the monthly figure. And that's a bad metric, because that monthly figure, there are some components of that rise over time, like taxes and insurance. But there's a huge portion of that, which is your mortgage payment, that is fixed over time, of course. Mm-hmm. And all of your rent, 100% of your rent, and renter's insurance, by the way, is increasing over time. So it doesn't take very long before your cost of providing shelter for yourself is less with home ownership than it is with renting. And you multiply that over decades, and you'll spend millions of dollars less on providing shelter for yourself than through renting. Renting will cost more over time, a lot more. It's one of our biggest expenses. So it's not so much that is it the best return on your money, because think about this. A lot of people will talk about, and I've heard Grant Cardone also make the same mathematical mistake, which is he'll say, if real estate, if it appreciates by 4 or 5%, you should put that money in the market or with me because I can make it earn more money or whatever. And people say that. It's not just him. They'll say, why would you invest in real estate when it appreciates by 4% when you can get 10% in the market or whatever? Which, by the way, I'm a market investor also. That it has its own set of pros and cons. But the problem with that thinking, if you're talking about your own residence, is like, well, I can't invest the money that I would use to buy a home into the stock market unless I'm willing to be homeless or move back in with mom. The money's got to go somewhere, and it's going to be millions of dollars. If you add up $3,000 a month plus inflation over the next 30, 40, 50 years, because you're going to need shelter your whole life, it adds up to millions of dollars. And so there's a good and a bad way to pay for that expense. There's a way where it costs less and it puts money and wealth in your pocket. And there's a way that gives it all away to somebody else. Again, back to that high level idea, if real estate investing were such a bad idea, then why do they do so well? And it doesn't mean that you have to be, there's a lot of people who just don't have the appetite to be a landlord. They don't want tenants. And I can understand that. Like if it just isn't your thing, that's great. But you should own your own house, because it's going to save you millions of dollars in cash flow over your lifetime, and it will put millions of dollars worth of equity in your back pocket. And some people will say something like, which is absolutely crazy to me, is they'll say, well, equity in your home isn't the same as money because you can't really spend it. And I think to myself, like, that's absurd. First of all, like 99% of all of the world's wealth is also not in cash. It's in things that people sell for cash. Like stocks, bonds, real estate, businesses. It doesn't exist in cash. So it's silly to think I only have wealth that I can count if it's sitting in the bank. That's not how wealthy people hold their money anyway. So if I have $1 million in equity in my home and I want to get access to that, I can sell it. I can borrow against it. That is much, much better than not having $1 million of equity in my home. Right? It's wealth. Right. And you tell a family who's having to take care of mom and dad and needing to sell their house to move them to assisted living or something like that, you're telling them that the proceeds of that house isn't helpful. That's just absurd. Of course it is. It is wealth. Yeah,
100%. It is a very powerful tool. And I mean, you mentioned that you're going to have to take care of mom and dad and things like. There's no. You can't do those things if you rent. Like you can't rent an apartment or a home and then be like, this is a 100% true personal example. My mom's getting old. I want her to come live with us. I'm going to build an ADU on my garage for my mom to live in. I can't do that if I rent my house. By the way, doing that is going to make my house worth more money. Like it's just like there's the levers that you can pull, the power, all of that. And having equity in the house is better than having equity in nothing and not having equity in anything. It's just, we could go down a whole rabbit hole about your point about the net worth of wealthy people not being, I often think, you hear people angry about how much wealthy people pay in taxes. And it's like, Elon Musk is worth whatever hundreds of billions of dollars. Like I'm not saying that people shouldn't pay fair taxes, but what people fail to realize there is Elon Musk doesn't have like a giant vault of $1,000 bills. Like that's not, his money is basically all stock in the companies that he owns. Like, so it's not just sitting there, which is no different than, like you said, the equity in your house, just in a different scale. And so treating your home like that business that has its own expenses, but also treating it like a business and say, okay, well, can my house generate revenue? Can I, if I really need that, what could I do? I could rent out a room. I mean, there are things you can do to flip that picture. And so I think, yeah, it being an investment is just purely based on how you treat it, and kind of the tools you're willing to use around it. So I probably mixed in a whole bunch of your points there, but I think that it's I completely agree. It's such a powerful tool that we have at our disposal that we don't have if you're renting. Just don't have those options.
Well, I love the story about your mom and the ADU, because that brings up another topic that I never hear anyone talk about. But once I articulate it, everybody's like, oh, that makes perfect sense. But nobody's really talking about it, which is there's very few categories in which you can spend your money twice. You can invest the money twice. And think about it this way. Of all the things that we buy, right? We buy food, we buy clothes, we buy, communications like, phones and subscriptions. Like, it costs money to live a modern life, and we spend money on all these things. In fact, that's what the CPI index is made up. They categorize things that people buy. They weight them based on how much they cost for people. And shelter is one of the biggest ones, right? It's a huge portion of that pie. And when you think about all of those things, there are different levels of luxury in that category. So let's talk about food, for example. You could technically live on rice and beans or something like that you could live off very, very inexpensive food. Most people don't want to scrape the bottom of the barrel in that category. They want to go out to eat every once in a while. They want to buy fresh groceries and things like that. They want to not live at the very bottom. And of course, the top of that category is just use your imagination, right? The most opulent, most of us don't have an appetite for that either. But it's, we all want to live somewhere that's comfortable, where we're eating healthy food, good foods, things that we like. But in order to upgrade your lifestyle in that way, it just simply costs more money. In order to upgrade your lifestyle with clothing, right? I don't want to wear rags. I want to wear something a little nicer. It just costs more money. It's just more money that I'm going to give away in exchange for a lifestyle increase that I'm comfortable with. And we all do it. We do it with our cars. We do it with our phones. Most of us don't walk around with flip phones, but they give those away, by the way. So you don't have to, I don't see how you could survive without a phone. Like, we need to communicate in a modern world, but you don't have to have the newest iPhone, but people do. Right. And I'm not judging that, by the way. That's a part of, if you can afford it, you decide what you're going to spend on your lifestyle. Now, all of those things, the more you spend, the more it just costs you to enjoy that lifestyle. There is one category that behaves completely differently, which is shelter. Rent would behave just like those things, right? You could rent a nicer place, and you're just buying lifestyle with the money. And there's nothing ethically wrong with that, by the way. I'm not judging people on a moral compass here, or on a moral scale. But with home ownership, something is different, and it's huge and it's meaningful, which is, I can spend at least some of the money that I use to increase my shelter. I get that money back, or my kids will get it if I die in the home. It's money that can be spent twice, because that thing has value. There's no other way. I mean, we could probably come up with some weird, like, if you really appreciate art could have that if you know how to buy it and you know how to sell it and you really appreciate it. But that's a really narrow niche for something that shelter is something we all need. So in investing the money, if you want to live a better life than just scraping the bottom of the barrel, your shelter is the most financially efficient way to live a better life. Like, is it a better life if you have a nice view and you have a yard where the kids can play and you have a 3-car garage because you want extra room to, like, that's a lifestyle upgrade and nobody would deny it. But you will get that money back, because someone will buy that again from you after it's used. Nobody's going to buy my hamburger from me after I buy it. Nobody's going to buy my shirt after I'm done wearing it. All those things get consumed, whereas real estate gets used in perpetuity, as far as we can tell. We will always need shelter.
Right. Yeah, 100% agree. I mean, and that's where you kind of circle back to what you talked about earlier. It's like you've got appreciation. Depends on, you don't know what it's going to be, but you've got appreciation over time. There's tax benefits. There's just, and as you pay, if you pay rent, the money's gone, right? the landlord's paying their mortgage down. If you own, the money you pay is actually decreasing it's increasing your equity by paying down your principal. So it's just something that, it's, I mean, maybe it's not impossible to calculate, but it would be probably hard to calculate exactly every single benefit that comes out of owning your home, because some of them are quantitative, but some are very qualitative. As you mentioned, it's like, I like living in this house because it has a view, or I like living in this house because it has a pool, whatever the case may be. Like, you might have different interests and desires for that shelter, but at the end of the day, if you don't own it, as you said, like, likely you are paying a spread of what the owner pays for you to live in that house, and they get the extra.
Yeah,
so it's like, why not?
That's profit, right? That's their profit.
Right. So
In fact,
why not do that yourself?
Yes, exactly. And another thing that I heard, that it was kind of a funny conversation. I was talking to this young woman, and she's like, well, I like living in this area where there's lots of people my age, and it's got, there's activities and stuff like that. And I want to have a social life, and you can't put a price on that. And I said, you can absolutely put a price on that. That's exactly what the landlord is doing. Now, I'm not judging her. It's just that people should know what they're paying for. And if you look at that and you see the price and you're like, I'm willing to pay that so that I can be in that building, as long as you know what you're paying for and what you're sacrificing, it's not unethical to do that. But to say that you can't put a price on it is exactly wrong. That's exactly what they're doing, is they put a price on that. Right.
Yeah. It's called the market rent. They do a study of, what people will pay to live here. And that's what we do it with our apartments. Like, that's how it works. And again, it's fine. Like, it is, depending on location, it might be less expensive to rent than to buy. And if you're planning on moving frequently or something, like, it's a short-term thing, like, yeah, maybe you do rent. But like, I think that the real point here, and you just made it with that example, is the awareness of what you are actually paying for, and saying you can't put a price on it is like, not to, I mean to sound cynical, but you almost can put a price on anything. Like, realistically, you can put a price on just about anything. And it's, that's the price is whatever you send them every month. Like, that is the price to live there and have that life.
It's a profitable business to be on the other end of that, collecting the checks. Right. And if it wasn't, guess what would happen? They would raise the rents until it was, or they would get out of the business. Right.
Yeah.
So when real estate investors are standing outside the grocery store with boots asking for donations because they're hungry, that's when renting will be cheaper than owning.
Yeah.
You know what I mean? Like, they're making money, clearly.
Yeah. Yeah. It's right. It is sort of maybe the oldest investment vehicle is property ownership, whether that was land many years ago, or now, apartments and office buildings and industrial, whatever the asset class might be. Brady, you talked about reverse mortgages, and you used the word elegant. I wanted to spend a little bit of time on, kind of talking about that and why you think. My knowledge of them is fairly surface, and I associate it, at least in my mind, with elderly people using reverse mortgages. And so I want to try and approach it myself with a completely unclouded view, but I'd just love to hear your take on it, because I've never heard the word elegant assigned to it before, but again, I don't know much.
So first of all, I'm not a huge fan of the term reverse mortgages. I use it because everybody else does, but it's a dumb name for it. I don't even know what a mortgage in reverse would look like. It's not a reverse mortgage. It's a line of credit. It's like a HELOC on steroids. So imagine a HELOC where when I borrow out money, if you could, you're a real estate investor. If you could get a loan, what would you prefer your minimum payment be? Like, you can always pay whatever you want, but what would you prefer your minimum payment be, your minimum required payment?
I mean, you want the minimum to be as low as it possibly can in case you have a month with unexpected expenses.
Yeah. And what is that minimum normally on a really good kind of loan for an investor? What's the minimum, even historically? it's usually interest only, right?
Oh yeah, yeah,
Investors
yeah.
go nuts on interest only loans because they're
Right.
like, I can always pay more if I want to, but if I just want to pay the interest, that's my minimum requirement without getting into financial trouble. So
Yeah.
a reverse mortgage is a line of credit where when you have a balance on the line of credit, the minimum payment is literally zero. You can pay whatever you want. If you want to make interest only payments, you can do that. If you want to pay principal and interest, you can do that, and it will pay principal down. It's borrowed money, and you borrow it against real estate, your primary residence specifically, but you can make whatever payment you want. So if you like it to go down, make payments. If you have something better to do with the cash flow somewhere else, you can let that accrue. Let the charges accrue on the balance instead of paying them out of cash flow, and do something else with the cash flow. And you can change your mind each and every day. So I could make payments for 3 months, change my mind, not make a payment, or if there's still available credit, I could take more money out. And any balance that exists, there are charges because it's a loan, but I can decide when and how to make that payment. And that's when there are features about it that almost sound too good to be true. So if I were to say, hey, I can lend you hundreds of thousands of dollars and you don't have to make a mortgage payment, it's like, wait, you're going to take my house or something. Like, it can't be that simple. Yeah. It is, well, the I don't know if I'd call it the other side. It has to be this way for this to be a financially viable tool. Of course, there's interest, and it will, but you can let it accrue or you can pay it, and it's entirely up to you. I don't know of any other line of credit that can work that way. That's crazy. And the thing, well, go ahead.
Well, my first question to that is, and this is maybe just completely wrong. My what I always thought about them was that basically it was effectively over leveraging, like you might owe, 110% of what the value of the house is, but maybe that's not true. So maybe that, like I said, my understanding is pretty was pretty limited on this. So my question along those lines is well, what sort of leverage? Because I wouldn't imagine that any lender would want to go beyond the value of the house with, in that scenario as it accrues. So how is that?
How's that handled?
Yeah. How does that get?
So there's a couple things to know. First of all, the most common reverse mortgage, to the tune of like 90-something%, by the way. So it's a huge majority of reverse mortgages are FHA loans. So these are built by HUD, insured by FHA. The CFPB has all sorts of requirements to make, like they're the most highly regulated loan in the country. And so these aren't, big bank Hanks loans from, the corner store charging 19%. It's an FHA loan. The rates are like at 6 and some change right now. They're very comparable with regular loan rates. But what they do to prevent against, or to protect against that, is those are pretty low loan to value loans. So they have an age requirement. So, and that kind of makes sense. If a financial institution is going to lend somebody money, hundreds of thousands of dollars, and not require a payment, they can't do that with a 30-year-old, because these aren't 30. There's no balloon payment on these. You can have this loan for the rest of your life. So they can't do that to a 30-year-old, because that could balloon for 70 years or more, right? So balloon is the wrong word in loan terms, because that usually means like a payoff, but that could compound for 70 years. So they're not going to do that. So you have to be 62 or older to use them. There are some products that you have to be 55 that are also reverse mortgages, but the FHA one, you got to be 62. And so that's one way they keep it from getting massive. Another thing they do is they give relatively low loan to value. So if I'm 65 years old, my line of credit would probably be about a third of my home value, not 80% loans. So these only work if you're old enough and you have a decent amount of equity.
Gotcha. Okay.
But the terms on them are almost unbelievable. I mean, I can borrow that money, and frankly, I could never make a payment the rest of my life if I didn't want to, and it would just get paid off when I sell the house. And the answer is yes. You could live till you're 112 years old, borrow the money at 62, and never make a payment if you don't want to. And then when the house is sold, the most common myth that people have about reverse mortgages is that the bank owns your home. And that isn't true, and it's never been true. It's simply not true. What happens when you sell the house with a reverse mortgage on it, the balance has to get paid because it's a mortgage. That's the way all mortgages work. So if I sell a house worth $1 million and I have a $600,000 reverse mortgage balance on it, or maybe I pass away. So that's an interesting question. If I pass away with $1 million home that has a $600,000 mortgage balance on it, so my kids inherit that, is that okay? The answer is, of course, that's okay. They just inherited
Happens all the
$400,000 of
time.
home equity. Yeah.
Yeah.
Like there's nothing wrong with that.
Yeah.
So that's how they keep it from getting upside down very often. But you can still imagine a scenario where if I'm 62 and I borrow out all of that money over the next couple of years to live a lifestyle that I want or whatever, and I never make a payment and I live till I'm 102 in that home, you can imagine a scenario where the balance exceeds the value of the home. And if I want to move, I'm what we call upside down, right? In the industry,
Right.
I'm upside down in that home. That would scare people. But reverse mortgages by law are what they call non-recourse. I don't owe that difference. It's actually paid by an FHA insurance policy. So if I owe, let's say my home is only worth 800 and the balance on the loan is $1 million, I simply do not owe the $200,000 when I leave the house. Now I don't have equity because I already took it out. I took it out in the form of borrowing against it, and I put it in my bank account. So I don't have equity anymore because I took it all out. But that $200,000 that I'm quote unquote upside down is paid in full to the lender. It's not my problem. It's an insurance pool that FHA sets aside, and it doesn't even hit my credit. Now, that's if you were to go to a let's pick a big company like Microsoft, right? Do you think they have lines of credit set up with financial institutions all over the world? And the answer is, of course they do. Well, why do they do that? It's because lines of credit are very useful tools. And so if you were to go to Microsoft and say, hey, I'm going to give you a line of credit. You can pay the balance whenever you want. You can either pay the interest and the balance or let it run, whatever you want. And whatever we collateralize, this financial institution, talking to the financial decision makers at Microsoft, we're going to collateralize this fleet of this or this operational or your accounts receivable or something. We're going to collateralize something. And if for whatever reason that collateral shrinks in value and you owe us more than the collateral, don't worry about it. You don't have to pay that difference. I mean, they would say, how much can I get and when can we sign? That's the most incredible kind of line of credit you could even imagine. And that's what reverse mortgages are. I think people don't understand that. There's a little bit of complexity to it because they've never seen anything like that before. And anytime something is new, people are kind of like, oh, let's wait to see what Dave Ramsey says about that before I make a decision. Who's not licensed and is nobody's fiduciary. He's a good brand builder, but he's very wrong about a lot of financial things. And so there's just a negative perception about it because people don't understand it. But that's what it is. It's incredible. In fact, the book that we wrote about it, we call it The Financial Ugly Duckling. It's a perfect metaphor. People see some similarities. There's a bill and there's webbed feet. And that, it's walking around, it looks like a little bird, right? It's kind of like a duck, but it's ugly. It looks different. But it's like, no, that's a completely different animal. It's a completely different species.
Yeah.
And there's one other feature that I forgot to mention, and it's one of the most important features, is that the credit limit itself increases from day one. So as soon as it gets assigned based on an FHA table, that's a percentage of the value of your home. But once it gets assigned, so let's say it's $300,000 or something for somebody's home, it starts increasing and compounding month by month. And I'm talking about the credit limit, not the balance. The balance is up to you because it's a line of credit. It depends on how much of the money you want to use. But the credit limit itself, if it starts out at $300,000, it's going to be 320, 322, 323 or something like that a year later. It's going to be 350 another year later. And 10 years later, it's going to be twice the size, something like that. It increases every month so that you have that line of credit in place, 20 years, it's quadrupled. It's doubled twice over 2 10-year periods. That would be a $1.2 million line of credit by the time you're 82. That's insane.
Yeah. Well, I was going to ask you that question because I thought about, you said, use the example of someone who takes this at 62 and they live to 102, like that's a long time. And I think, if it's based on a I say low, loan to value, low comparative to maybe other mortgage products, but still, like if it's, $300,000, like you mentioned in the example, but your house doubles or, over those 40 years, your house is probably going to double or triple in value. That if even keeping that same loan to value ratio, you would have in theory more line of credit. And so I was going to ask you if that happens. So it sounds like that's exactly what does happen.
Yeah. So, and remember, it's a line of credit. So so people will say, so if my loan to value is 400, let's say, and my property is worth $1 million, then in 10 years, the loan could be 800,000. It's like, hold on, it's a line of credit. It's not a loan. That's how big your line of credit is. The balance is completely up to you. I mean, you can't go higher than the credit limit, but the balance is whatever you want it to be. If you want to take money out and put it in your pocket and go, live a lifestyle or use it to visit kids and grandkids, great, do that. You can put a balance on it if you want to, but we're just talking about the credit limit and the charges, just like any other line of credit. The charges are commensurate with the balance, not the size of the credit limit, right? My credit card costs the same, whether it's a $50,000 limit or a $30,000 limit or a $10,000 limit. The cost to keep it open is essentially zero. I mean, it might have an annual fee if it's that kind of credit card, but the balance is what creates the charges. So we're just talking about the credit line. So if you have an $800,000 line of credit by the time you're, 70 or 80, that's not costing you money. If you don't, the balance is what costs you money. If you decide that's worthwhile doing.
Right. Well, it's funny. I mean, just in sort of bringing it full circle, going back to your house, your personal residence as a investment, right? If you bought a house and you paid it off, or you almost paid it off, and now you're in your retirement years, and maybe you don't have, a huge 401k or whatever the case may be, you don't have a ton of other, this is essentially a tool that you can use in retirement to cover any, kind of shortfalls you might come up against in terms of your actual retirement planning. So it's, I think that it's just building the case for, owning a home and
absolutely
the value of the equity in that home.
That's exactly what it's for. I mean, if you look at why FHA put it in place, which they did in 1988, it's been under our noses for almost 40 years. But the reason they put it in place is to make the home equity that you live in a liquid asset, because it's illiquid if you want to live there. Like if you need the wealth that's sitting in your home, there's only 3 ways to get it. You can sell it. And that's the most expensive way to get to your equity, by the way, because realtors don't work for free. There's title transfer fees depending on the state that you're in. There's other costs. Selling a house isn't cheap. There's maybe some deferred maintenance, maybe some inspection items that you have to pay for the buyers to close. It's very expensive to get at your equity that way. Now, if you want to move for other reasons, if you want to go into a different place, that's perfectly justifiable. There's reasons that people move that aren't just getting at the money. But if that's how your plan is to get to the money, that's the most expensive way to do it by a huge margin. The second way you can get it is by borrowing against it with a traditional loan that requires a payment. And then you have to account for the fact that you need to make payments, which is fine. And that is the best solution in some circumstances. But you also have to qualify for that loan, which sometimes can be hard in retirement at that age because you don't have the W-2s or the income to justify that. Yeah. Now, you can get bank statement loans and other kinds of loans where they don't look at that, but it's a higher interest rate to do that. And then the third way you can access it is with a reverse mortgage, in which case, if you want it to behave like a regular mortgage and make payments, then make payments. But you don't have to make payments if you don't want to. And what's funny is, like, if you do that at age 65, how do you know whether you're going to want to make payments at age 85 or not? Like, it's convenient to have the option to make payments if you want to and stop if you want to, or take a break if you want to, if you're trying to catch up on some other bills. It's the most flexible line of credit that I've ever heard of. Mm-hmm. And the thing, often people will say, well, yeah, all that stuff you're saying is true, but they cost quite a bit of money. And which is another reason why we call it the ugly duckling, because people look at it and be like, oh, I can see that it's like a mortgage, but it looks ugly because it costs more. And they do cost more than traditional loans, by the way. And I think to myself, you got to stop comparing it to something that it's not. If you want me to give you a line of credit that is guaranteed to grow until that loan is done, until you pass away in the house or sell it, right? You could have this loan for 40 or 50 years, depending on how advancement, maybe 50 years if people start living longer, but you could have this loan in place for a very, very long time. I'm not going to require payment. I'm going to increase your credit line. You're never going to have to pay it back until you pass away or sell the house. And all of that is going to be non-recourse. So if it exceeds the value of the collateral, you don't owe me that difference. If I'm the financial institution, how much should that cost? Like, right. That's not a mortgage. That's a completely different animal.
Yeah.
That's a huge asset in your back pocket. And another thing that worries people about reverse mortgages is they think, okay, if I borrow $100,000 and I don't make a payment, and let's say it appreciates by 7.2% a year. So 10 years later, I'm going to owe $200,000. If that doesn't freak you out, you're probably not human. Our intuitions scream against that. But that's just an emotional problem. It's not a math problem. Because the math says, well, yes, but if you need $100,000 and you take it from money that would otherwise been invested, you're still going to be $200,000 poorer 10 years from now. Because if I take $100,000 out of my investments and spend it, it will not be the $200,000 that it would have been otherwise had I left it alone. But if I leave it alone and it does become the $200,000 that it would become by leaving it invested, but I owe $200,000 instead, my balance sheet is still the same. Right. If I have a $200,000 asset and a $200,000 liability, my balance sheet is zero. If I have no asset but no liability because I sold the asset 10 years ago, my balance sheet is still zero, which is exactly why what wealthy people have been doing for hundreds of years. I'm not making this up. This is something wealthy families have done for literally hundreds of years. They don't sell the assets. They borrow against them for the reason that I just said. If they keep it, then it stays appreciating on their balance sheet. And if they owe money against it, it has the same net effect on their balance sheet as if they'd sold it. But two important reasons why they do that. One is there's no tax consequence for borrowing against my asset that's appreciated. Whereas if I sell it, I have to pay taxes on the gain. So people borrow against it instead. And so it has the same net effect on my balance sheet, except they don't have to pay taxes. The other reason wealthy people will do it is sometimes that asset that we're talking about is illiquid. So they can't sell a portion of it anyway. And that's exactly how home equity is. If I want $50,000 of my, say, $500,000 of home equity, I can't get 50,000 of it by selling it. I can't sell $50,000 of my equity to someone. I either sell all of it or none of it. But by borrowing against it, I have essentially made my home equity a liquid thing now. And what frightens people emotionally is that they see that $50,000 double over the next 10 years to 100. And it's like, that's just the way money has worked since inception, since the inception of money. But if I borrow 50,000 and it keeps me from selling 50,000 somewhere else, it's the same thing. It's a method of spending your equity that somebody very clever figured out and put in place and is now an FHA type of asset. But it is different and people struggle with it because it's more complex than what they're used to. I'm going to save money and then later I'll spend it and I hope I don't run out. It's more complex than that. There's one step of complexity above that, but it's brilliant.
Yeah. Well, and I would say even that example of, the 100 of borrowed money turning into 200 over 10 years, but it's within the equity of your home, which has probably increased over time as well, maybe in a linear probably pretty darn close to that additional owed in interest. So it's kind of like it's still, it's far better than selling something and not having it anymore, because then it has no chance to appreciate. So whether we're talking about money in the stock market or whatever, like it's just, and I mean that's one of the, just real estate in general, like the reason why a lot of my podcast guests and why I talk about it, whether it's your own home or rental properties your own or whatever, like the reason why I see it as a better option than like your traditional 401k is because you have to sell the assets of the 401k to access the money. Whereas if you have income producing real estate, you don't have to sell it and it's going up in value over time. So it's kind of like in the stock example, you get one or the other. It goes up in value or you sell it and you get the money out. So there's certainly dividends and things, but it's just, the point is, it is a extremely powerful tool. And what I love about, kind of having these conversations is just the understanding of your options, right? And so like, you're in retirement, retirement age, this may be something that could be extremely valuable, if not life-saving to you, to be able to access that equity in time of need. Right? Like an illness, something like that. I mean, it's just, there's things that happen, things come up, and this is, your home can be that asset that can help you get through it, and knowing how to utilize it is, I think, extremely important to people. So, I appreciate you sharing all of that. I think it's great information in the way that you explained it.
Well, can I say, do you mind if I say one more thing, or are we out of time? Because I want to,
Yep.
I know a lot of your listeners are investors and they might be thinking, well, how could I use this? And if you're over 55 or 62, depending on which product you use, it's available for that. And we do help people with that. But by far, the majority of people that I see using reverse mortgages are people who have run out of other options. And what really bothers me, and this is why it's important for me to say this, because I feel like it's a almost like a PSA. Like if people, people listening to this probably know people in their lives that are strapped for cash but have lots of equity. And I've literally had conversations with people who are embarrassed. They don't want their kids to find out that they've run out of money, and they have lots of equity in their house. And they're just like, I mean, somebody really said this to me the other day. He said, I'm embarrassed, but I'm tired of eating peanut butter sandwiches and hot dogs. That's all I can afford to eat. Now,
Yeah.
if those kids were to understand, hey, we can use the equity in their house and it's okay. A reverse mortgage isn't a bad word. It's just a way for them to tap into their equity without having to sell the house and without having to make monthly payments. And so if you were to say to their kids, a lot of people will look at that and say a lot of kids don't want mom and dad to do a reverse mortgage because they'll get less inheritance. And I've heard of that. And I imagine there are a-holes out there. I don't know if we can swear on this podcast, but
Yeah.
I imagine there's a-hole kids out there that really do feel that way. But my experience has always been when the kids are against the idea, they're usually against it because they think somebody's trying to trick mom and dad into doing something and the kids don't understand it. But once they understand how it works, like, can you imagine your parents? Could you imagine your parents skipping meals or, cutting their prescription pills in half just to make sure that you inherit more equity because they don't want to use their equity as a lifestyle, they don't want to spend it on maintaining a decent lifestyle. If you're a decent guy, and I assume that you are, you'd be furious with that. I would be like, Mom and Dad, I don't care if I get nothing. If you make a single sacrifice with your lifestyle so that I get a bigger inheritance, I don't want that. And so if you run out of cash and you're living in a home with plenty of equity and you're worried that I will get less equity if you use a reverse mortgage, don't think that. Use your equity, spend it. I'm perfectly okay with that. And once the kids see that, they're like, oh yeah, we want mom to be healthy and happy or whatever. So the reason I'm saying that is you probably have people that are listening that know people in their families or in their communities. And they just need to know that a reverse mortgage is a very valid tool. It's giving people access to their equity, and it's a clever way of doing it. It's beautiful. It's elegant. And I'm hoping to just try to dispel a little bit of the fear out there, because there are literally people out there suffering in that way, and they're being told by their children, not because their children are ill and they don't have ill intent. They just don't understand it. They're saying, no, mom and dad, don't do a reverse mortgage. I hear they're bad. They're not bad. They're a clever financial tool, and it's keeping mom and dad in a position of poverty. There's something can be done for them.
Yeah.
So I think people need to hear that.
I'm glad that you said that, because I do think that's, I mean, this, we go down a huge rabbit hole about being a parent and wanting the best for your kids, and parents sacrifice, basically you in a lot of ways you start sacrificing the day your kid's born and to give them the life. And so, but I think that when it gets to this point, your kids are gonna want to be the ones to they're going to want you to do for you. They're going to want you to, if that is a tool that allows you to live comfortably and be, have your final years be something enjoyable. Like, even, I mean, of course we don't want our parents eating, peanut butter and jelly all the time and whatnot. But even, from the perspective of being able to stay active and present in the lives of maybe their grandkids and stuff like that. I mean, I think there's just so much to that this is where understanding and knowing what tools are available to you is just such a huge advantage. I hope, I mean, that's what I want from this podcast. That's what I really hope comes out of this podcast, like this episode, but also in general, is that hopefully someone hears something that helps them or a family member, like, give some realization about, having an option, just having an option and not being stuck wherever they are. So
yeah, and when we think about wealth, we often think of the wealthy, right? We think of opulent places and buildings and cars and restaurants and things like that. But it's also true that wealth is also the solution for mom and dad who skip a meal or who don't go visit their kids and grandkids. Wealth is the solution for turning that life of destitution into a life of dignity, right?
Yeah.
So it's not all about opulence. It's about helping people. Wealth is important.
Right. Yeah. I think it gets assigned a certain meaning that isn't it's assigned a meaning that becomes very exclusionary of people that don't think they have wealth, but I think sometimes it's just a matter of understanding that it is accumulation of the good, the assets in your life, and that might be your house, it might be your family, it might be some money, like whatever it is. But I think it's just understanding all of that and how it all ties together is just huge. So,
Yeah.
Brady, we are running out of time here. I want to make sure that I ask you a couple questions that I ask every guest, and the first one is maybe we just hit on this a little bit, but the name of the show is Know Your Why. And so I do like to ask every guest, what is your why? What's, what's driving you? What's continuing to make this stuff important? And I feel we probably touched on some of both of our why just a minute ago, but
Yeah.
want to give you the chance to kind of expand on that if you want to.
I think we all like helping people, and I find tremendous satisfaction in aligning what I do naturally. Like I'm a numbers guy. I like crunching numbers and building pro formas and things like that, and then showing people how certain decisions can improve their lifestyle. And again, it's fun to help wealthy people save on taxes or think of interesting strategies and ways to do this or that. But it's also tremendously satisfying to help people who are just trying to live a good life. And they're not maybe trying to be wealthy. They're trying to not like crazy wealthy. They're just trying to spend time with their kids and trying to make sure they have enough to send their kid to college or live comfortably and go out to eat once or twice a month with their family and have, just there's value in that. And wealth is the answer to that. It doesn't solve all problems, but it solves a lot of them.
Mm-hmm.
So I find that tremendously rewarding. I love that stuff.
Yeah, fantastic. When people hear this and they want to connect with you, what's the best place for them to reach out?
Email's the best way to reach me. Yeah, brady.mullen@ccm.com. So I was hired by Cross Country Mortgage about a year ago. They saw some of my content and they were like, hey, we want to help get this message out. So I'm not a lender. I work for a team and we do a lot of reverse mortgages, but we obviously Cross Country is a big national lender. We're trying to help people understand that the liability side of their balance sheet is just as important as the asset side of their balance sheet. It's just as important to get that right. And financial advisors don't often talk about the liability side of the balance sheet. They'll mention it, they'll put it on the balance sheet, but they don't talk about how to optimize that, how to make sure, like these are 6 and sometimes 7-figure financial instruments. It's important to get them right because they're very long levers. So it's important to integrate that into the bigger picture and collaborate with the financial community, bring those worlds together to help people live better lives.
Yeah. Completely agree. We'll get that your email there in the show notes so people can connect. Listen, thanks. This was a fantastic conversation. I think I certainly learned a lot. I appreciate you being on. I appreciate everything that you shared. So thank you very much.
Thanks, Jason. I appreciate it.
And folks listening, make sure you connect with Brady. Please like, rate, and review the show so we can continue to get great guests. And as always, thank you so much for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?